Hi there, Addy here from TontonianOnline.com here with a couple of properties. It's been a very busy week. The weather is getting nice, and we are seeing a lot of listings coming in the market and a lot of multiple offers taking place as well. We listed a property on Friday that I had posted about on the website, and the property is already sold conditional, and I'm due to go for an inspection of the property in a couple hours. So the number of listings is increasing, so are the number of buyers. I think it's the prolonged winter that we have. Everybody's coming out of their shells and going out and buying properties. I have two new properties. Both are Plex that are coming up this week. What we're looking at doing right now is just go over the numbers for you. You can take a look at them, and if it's something interesting, you can get back to me and we can chat more. The first one we have is on Dewson Street. Dewson Street runs is north of College and runs parallel to College off of Ossington. So let's take a look at the overview. We have 5 units in total. Asking price 1,325. Initial cash investment for this one is going to be 309,500. Net operating income, again, this is not gross, this is net, 6134. That's before mortgage payment. And your cash flow from this property is $842. Amazing numbers. 5.6% cap rate. Cash on cash return is 3.3. Usually we see this as 1%. Because of the 5.6% cap rate, it's at 3.3. Based on our assumptions, the projected price in 10 years is around 1.78, and that's mostly based on an income approach. Again, there's no way of predicting it. It's a nice feature that this program that we're using now has, so we include that in there. It's a semi-detached property located in the College and Ossington neighborhood. Property generating good cash flow, priced at 5.6. It's showing 5.5 over here. All residential unit occupied, and it is a corner property, and it's a semi-detached property. So this is Dewson right here, Ossington, College, and this is Harvard over here. So just to give you an idea of where the property is located. Let's look into details of it. So the first mortgage, 80% loan to value would be $1,060,000. Down payment requirement for 1,325 is $265. Estimate on buying cost is around $44,500. Total cash requirement is $309,500. 5 units, $265 per unit. Again, if you've been following this blog, this is something that we pay attention to. We see a lot of properties in Toronto getting listed between $250 and $350. We did a multiplex deal in the Annex, 10 units last year in December. That was around the $350,000 per unit mark. And this one is on the low end at $265,000 per unit. Monthly average is around $1,510. Again, loan to value ratios were at 80%, and that's the loan amount. The numbers we use for the mortgage is 25-year AM and 3.5% for your interest. Right now, you can get better than 3.5, but we like to keep it a little bit conservative, so you can see, okay, there's definitely potential in this property. Let's take a look at the income. So $75.50 per month, that's the gross. $73.39 after a 2%, after a 2% vacancy rate. Cleaning and maintenance is at $120 a month. Insurance is around $205. Taxes $384. Water, sewer, garbage removal, that works out to $174. Hydro is $142. Now there's some units that are paying their own hydro, some are not paying their own. No, I apologize. This is a different property. So it's $174 for $142 for hydro per month. Gas is $155. It's forced air throughout the it's radiant heat throughout the building. There is no air conditioning in this building. And the internet is at $85 a month. The owner currently includes the internet for their tenants. So net operating income after the expenses is $61.34. Your mortgage payment of $52.92, which we calculated right here. You have a positive cash flow of $842 a month. Now this property is not going to last, and we might be getting multiples on this one as soon as it comes on. Best bet is to get in on it faster, sooner than later. So some of the assumptions, financial metrics. So 14.6 is your GRM, your annual GRM. In Toronto, we see this at around 11 to 12. It's actually very healthy, 14.6. Operating expense ratio at 17.1, which is on the low side. Usually you see properties with higher operating expenses. Healthy is somewhere between 20 to 35%. Debt coverage ratio is 1.16. Cap rate 5.6%. Cash on cash return 3.3. So here are some assumptions. So we assume that the property is going to appreciate at a 3% rate per year. Vacancy 2%. Income inflation, so the income will increase. So you're going to be able to increase your rents every year by 2%. Your expense inflation, so you're going to see expenses be going up too. That's going to be around 1%. Loan to value for refinance. So there are two ways of getting out of a property. One is to refinance it. Second is to sell it. So if you were to sell it, refinance it, you're not going to be able to get more than 70% of the value. So what that means is that you have to leave 30% equity in. If you can get higher than 70% LTV, your rate is usually higher. So best is to actually keep it at 70, and then you have a lower rate. And then the selling cost, 86,125. This is based on an average of the sale price, and that's based on year 10. So looking at some detailed financials. So as you can see, the income is going up, and your operating income is increasing. And what we have is year 1, 2, 3, 5, 10, 20, and 30. So just to give you a basic idea, what I want you to pay attention to, and again, this copy is available for download if you just look below, or just drop me an email, addy@heyaddy.com. You can take a look at it in a lot more detail and understand exactly what is happening. So from an incoming analysis, your return on investment, it's being calculated right here, and that's your cap rate based on the price. But the main thing we want to look at is potential cash out refi. This is what we're looking for. So at year 3, if you were to refinance this property at 70% LTV, you can get out 40,000, 37,720, which is a really decent number to have. The other thing is the property is generating about $860 every month, so there's some potential savings over there too for you. If you were to sell it, your equity in year 3 is probably around $472,000, and your cash out is going to be this is after you paid out your cash invested, is $103,678. Again, really good numbers. 33% rate of 33% return on your investment, not annually overall. That's your return on investment. Give you there are a couple of graphs in here. I'm not going to go into too much, but here's the rent roll that we have. Apartment 2 and 3, which is on the second floor. They're 2 units at $1,050 each. Apartment 4, 2-bedroom on the third floor, which is $2,200. This one actually just became vacant, so it might be going down to $2,100 or might stay at $2,200. It's just going on the market right now, so that will be finalized. Basement, 2-bedroom, $1,350, and main floor 2-bedroom is currently rented for $1,900. So total units are $575.50 per month. And in terms of your closing costs, these are the items we had. Land transfer tax at $42,000, lawyer fees at $2,000, and $500 for inspection. If you have any questions, you want more information, call me 1-877-439-2339, or you can email me addy@heyaddy.com. Take care, and I will talk to you shortly again. Bye.